Peter Thiel, Max Levchin, Luke Howard, and others created. We combined the companies and made PayPal. So we're thinking about money for a long time. And really, it's best to think of money as an information system, primarily an information system for labor allocation. And for practical purposes, it exists in a series of heterogeneous databases, like very different databases in bank mainframes around the world. It moves quite slowly in reality. It seems to move fast sometimes, and it does with PayPal, which is real time. But the vast majority of the
do you think Bitcoin can become peer-to-peer cash?
The actual reconciliation may take 1 to 5 business days. You have the ACH system, which is ancient and still in operation, which is allows transfers effectively like a check would be an ACH transfer, but it's not secure. And you've got the credit card systems, which are also not secure. It would be like handing your username and password to a stranger in a restaurant if you buy a meal. So there's definitely an opportunity for something that is better from an information theory standpoint. So and there you can think of it like data on a network. I think is the way to view it. What has the most throughput? What has the least error? What drops the fewest packets? Fraud, for example, being a source of error, and government interference in currencies being a source of error. But it's fundamentally an information system. So I think it makes sense to support something that improves the quality of information with which we conduct the economy. And Bitcoin is a candidate for that. It does, I think, some things well, and it's obviously it's evolving, and there are additional things like Lightning being done on top of Bitcoin. But Bitcoin per se is mostly solving for scarcity, or rather solving for essentially having no throat to choke, decentralized. So there's no one who can be coerced in any way to empty their Bitcoin account. Well, I guess they could technically, but on an individual basis, but the system as a whole cannot. And it has an open ledger, which is also quite good. But transaction volume is low. Transaction cost is high, and usability for the average person is not yet very good. But it has a lot of potential. And I should say that, like, I'm not, and I apologize for taking a long time, but there certainly is a lot to say. In general, I'm a supporter of Bitcoin and the idea of cryptocurrency in general. But as I've said publicly, we do need to watch out for crypto taking, especially Bitcoin, using proof of work to maybe use energy that's maybe a bit too much and not necessarily good for the environment. So, but on balance, I support Bitcoin, and I'm not an investor. The only publicly traded stock I own is Tesla, and the only significant thing I own outside of Tesla is my SpaceX stock that help create both companies. So, but apart from that, I do own Bitcoin, and Tesla owns Bitcoin, SpaceX owns Bitcoin, and I do personally own a bit of Ethereum and Dogecoin, of course. So.
Okay, great, thank you. And we'll get into some of those issues in more depth as well. Jack, how about you? What shaped your views of Bitcoin?
The network and the community. It's deeply principled. It's weird as hell. It's always evolving, and it just reminded me of the internet when I was a kid. And I encountered alt cypherpunks when I was fairly young, and this was a topic of discussion for years. I didn't touch it until 2008 when we started Square. Elon and teams at X and PayPal inspired a lot of what we were trying to do, trying to bring in more to a physical world. But we encountered this crazy predatory system that was slow, that was obtuse. And I think, one of the things that we tried to do, which X and PayPal also tried to do, is build an abstraction layer around this complication and around this predatory nature that the financial industry can tend to be, and make it work for people. But when I saw Bitcoin in 2009, you see a chance to replace the whole foundation. And everything that Elon was talking about in terms of ACH and the credit card networks were built with very different agendas in a very different time frame. And it's crazy that they still exist, and they have scaled, but they just are not relevant to today, and they're certainly not relevant to the future, especially when you consider the entire world and countries like Nigeria or Ghana or India, and its interconnection with countries like the United States and Canada and all over Europe. So what really drove my thinking and drives my passion around it is, like, if the internet gets a chance to get a native currency, what will that be? And to me, it's Bitcoin because of those principles, because of that creation story, because of its resilience, because of the number of tests it's been. But what inspires me the most is just community driving it. It just reminds me of the early internet. It's the only reason that I have a career, because I learned so much from people like who are building Bitcoin today, and I continue to learn in that sense, and I'm so grateful for it.
So that's a good segue into the next question I'd like to ask you, Jack. Is you said before that Bitcoin changes everything. Can you speak more to that?
Well, I just think that a lot of what we experience in life, when you really get down to the foundation, a lot of our monetary policies, a lot of our monetary systems cause so much distraction and so much cost. And when you get to a system where you have the potential for people to truly own it, they can verify it themselves. You don't have to have trust going in. You don't have to trust it at all. You can verify it through source code or whatever your appetite is, and that any particular person can help drive the future of it. And at the same time, it's not controlled by any state. It's not controlled by any bank. It's not controlled by any corporation. And these three parties of people who participate in the network, people who mine, and also the developers, constantly debating the correct roadmap and the way forward, is a beautiful thing. And I don't know of many other consensus-based models that have existed at that scale for this long with this amount of success. And we're still fairly early. So when, I met a woman in Ethiopia 2 years ago, and she was trying to create the lift for Ethiopia. Elon, I think I reached out to you at that time as well, because she really wanted some Teslas. She still has to take paper fiat cash from her passengers and pay all of her drivers in the same way, because there's no monetary system that she can utilize. There's nothing digital. And Africa as a continent is hugely interconnected from a monetary standpoint, but also hugely taxed in that same way. So a lot of the potential that I see, the internet having a native currency helps her build her business in a much faster way. And also, if you consider something like Bitcoin existing before YouTube, before Twitter, before Facebook, a lot of the business models that we have today would not be the same. We would certainly not have the dependency we have upon the advertising business model if Bitcoin existed pre-Twitter. And I think the amount of business models that it enables, the amount of innovation it enables going forward, especially when you can consider the whole internet instead of going country by country by country by country, which you have to whenever you're doing with finance, it really just opens the aperture. And that is what I want to see in my lifetime is a currency that is standard and sound for the internet that everyone can use.
Great. A hallmark of Bitcoin is its fixed supply of 21 million coins. Elon referenced that earlier. It may be the first system that humans have created that humans cannot later change. Kathy, I'm curious, with your background in monetary history and macroeconomics, what are your thoughts on that type of system?
Oh, well, I'll recount the story about Art Laffer and our going through the paper, and he said, as I said, first rules-based monetary system, global, ever. This is a very big idea. Once we had convinced him of the ecosystem itself. Now, this is the role that it's playing, given that the rule is a quantity rule, that 21 million units, is really a store of value role. So there are three roles of money. Store of value, very important. The means of exchange, so for transactions, and the unit of account. Every good priced in terms of whatever the unit is. So store of value is its primary use right now. The others exist. Unit of account, reserve currency of the crypto asset ecosystem. That's being seeded a little bit towards stable coins right now. But the store of value is a very big role. And means of exchange with apps built on top of the Bitcoin blockchain, we think is going to become more of a reality. Right now, high value transactions take place over Bitcoin, and that is a very useful role. So we look at those, and I remember saying to Art, "How big could this be?" And he said, "Well, how big is the U.S. monetary base?" Well, today it's $8 trillion. $8 trillion. At the time we were talking, it was $4 trillion. So we've gone through another crisis since then. And so this store of value, this idea that purchasing power will go up over time if demand rises relative to supply ultimately fixed at 21 million units. That's a very good thing. Purchasing power going up globally around the world. And this idea that it's a hedge against confiscation of wealth. And that can take place in a myriad of ways. But inflation, and especially hyperinflation in emerging markets, is the primary way. Talk about destroying purchasing power. So that's a very big idea. And I'll also mention deflation. In some ways, it's a hedge against deflation. I know some people are confused that we at ARC think that we're in a deflationary environment here in the United States. If that is true, the odds of a hyperinflation in the rest of the world, especially in emerging markets, is also true. So, but this deflation, and we learned from 0809, there's counterparty risk associated with deflation. And I think Bitcoin would be a hedge against that eventuality as well. So it's a very big idea.
Right. I suspect among us, there's not a lot of debate about Bitcoin's potential as a store of value. But Jack, you referenced earlier it being or becoming the native currency of the internet. Can you speak more to that, and also how it relates to maybe how institutions think about it?
Yeah, I mean, like just simple example. If I happen to be in Ghana and my family is in Nigeria, currently I can take anywhere from and I need to send money back, anywhere from 10 to 30% off the top just to send that money back. Whereas if you just focus on the worldwide remittance problem, Bitcoin solves so many of those problems today instantly without having to go through any intermediaries or any slowness or complicated systems that a corporation or a state created. So I think having sound money with that is
average validate a particular piece of data drops below somewhere between 100 and 200, then you get a risk that an attacker with a relatively small share of the network will be able to just corrupt specific pieces of data by random chance. There's also the risk that if a particular piece of data is stored by only a few hundred nodes, then it will happen that at some point there's one piece of data that literally everyone forgets and then it's unrecoverable. So there is definitely, in my opinion, a natural kind of floor to the extent to which we can get the inefficiencies down, at least at base layer.
Yeah.
And somewhere between a factor of 100 and a factor of a few thousand seems to be where that floor is.
Interesting. So, and then on the top end, is there an alternative to that? Is there a side at which it becomes so inefficient, or is actually the idea is it has to be a walled computer?
This is called Bitcoin and Ethereum 1.0
yes.
and all these other systems that exist today.
So yeah, that's fair. So then, speaking of the kind of the base layer, and then moving up to layer 2, there's a couple of layer 2 technologies out there. Of course, Bitcoin has its own with the Lightning Network, and there are a lot of different discussions about the pros and cons of layer 2s. So let's define layer 2, talk about pros and cons of the concept of layer 2 solutions, and then talk about the Ethereum specific ones.
Sure. So the general idea behind layer 2s is that instead of trying to scale the blockchain itself, you change the way that applications that use the blockchain are designed, so that instead of shoving literally every single interaction between an application's users onto the blockchain, they try to make interactions happen between users directly first, and then only push data to the blockchain in the event that there is either a dispute or some kind of failure on the part of one of the participants, or he wants to exit the system and possibly switch to a different layer 2. So the simplest mechanism to explain is probably payment channels, and we could even go through payment channels. That's a fairly kind of illustrative example. So let's suppose, for example, that I'm trying to sell you an internet connection.
Yeah.
So I have a phone, it's connected to some cellular network. You have a phone, it's connected to nothing. You want to borrow my data at the cost of 4 cents a megabyte. Then we connect to each other. You put, let's say, $5 into a channel. And then a channel is a smart contract. So you put the $5 in, and by default, you have the right to just take the $5 out at some point later at any time. Now, then if he wants to pay me for 1 megabyte, so I do 1 megabyte of data, instead of you publishing a transaction on chain, you sign a ticket. So you sign a message off chain that basically says, all right, I agree that I have now given up 4 cents, signed Simon. And you send this to me, and now I have it. Now, if you want to pay for another megabyte, then you sign another message, and the second message says, I now agree that I have been willing to give up 8 cents. And then you sign a third message that says, I'm now willing to give up 12 cents.
Yeah.
And the rules of the smart contract say that either of us can start and exit from a channel, and then after that, there is some period of time during which either of us has the ability to submit messages, and the message that has the highest sequence number attached, so basically the message that is the latest, is the message that wins. And so if I have a ticket that says I received $2 from you, then I myself know that within this period of time within which either of us can send messages, I can send the $2 into a channel, and I know I'll be able to get the $2. And so the clever trick that's being done here from an economic perspective is that even though the base layer itself is not being modified every time we send a message, but the base layer implements this kind of game, and the equilibrium of the game, the outcome that both of us know will happen from the game were we to decide to play it, does change, and it changes as a result of us gaining access to messages that the other of us has signed offline.
So if I was to describe it as being netting but for the network, would that be a clumsy analogy or reasonably?
Netting is definitely a great analogy for this. But the general principle here, right, is that you try to just do stuff off of the blockchain, and only when there's, like, for example, I just randomly go offline, or you decide that you want to take back your money, but you try to claim you only paid 4 cents, or something happens like that, then you appeal to the blockchain. And Plasma is a different style of construction, but it uses very similar principles.
Interesting. I like the idea of appealing to the blockchain. That's there's going to be like an appeals court and appealing to Ethereum.
That's definitely one of Joseph Poon's favorite analogies.
Yeah, I really enjoy it, and I think kind of flipping that on its head as well. Like when I start thinking about netting for the whole planet, that starts to get really interesting, because netting typically requires financial institutions, a lot of cost and intermediaries. Whereas actually, if the whole planet can net off, the efficiencies could be really huge.
It is worth noting that channels in particular do have capital inefficiencies, because especially once you start talking about these networks of payment channels, and then I have a channel to you that has $5 in, and I have a channel to someone else that has $5.
That
and then,
$5 is committed to that channel.
Exactly. So I have $5 that's committed to each of these channels, and then when you start talking about networks that get kind of routed through multiple channels, then the amount of money that needs to be locked up for certain types of payments to be possible is fairly high.
Yes.
And Plasma actually does score better on that scale, but Plasma has the disadvantage that in Plasma, confirmations are not instant. So in a channel, confirmations are instant because as soon as I receive a payment message from you, I know that I'll be able to shove it into a smart contract,
Yes.
so I immediately know that I theoretically have the money. But in a Plasma system, you have to wait until a commitment to a lot of pieces of data gets published on chain.
Yeah, I see.
So Plasma has better capital efficiency. It needs to lock up less money for it to work, but on the other hand, it has this slower confirmation time.
Let's just step back and define Plasma as well for listeners who aren't familiar, and then jump to Colin on capital efficiency, because I know that's a point that's key for him.
Sure. So the way that Plasma works is kind of like this. So suppose you have a Plasma chain that has some single operator. So let's say I'm the operator, and I have a lot of users. And there's also many separate kind of coins that I'm keeping track of, or that the Plasma chain is keeping track of. And for simplicity, you can think of, say, 1,000 coins as being 1,000 separate objects. So on the actual ledger, on chain, these 1,000 coins are all controlled by the Plasma smart contract. And what happens is that there exists some kind of mapping of ownership based on these messages signed off chain that says that you have this coin, someone else has this other coin, someone else has this third coin. And if you want to send your coin to someone else, you send a transaction that does that.
Yeah.
And then every 15 seconds or minute or some interval of time, I take everyone's transactions that were submitted basically since the last time I made a commitment, and I put these transactions together and make a cryptographic commitment to them. So for more technical people, basically, you make a Merkle tree, you publish the Merkle root on chain.
Yeah.
But what this means to a kind of technical layman is that I am publishing a kind of piece of cryptographic data on chain, where the piece of cryptographic data is very small, but I can use that piece of cryptographic data later to prove to anyone that some particular transaction was included.
Yes.
Or I can also use it to prove that for some particular coin, so say for coin number 193, no transaction was included at that particular time.
Yes.
And so what you can do is that if you want to check that you actually have coin number 193, you ask the Plasma operator for the entire history for coin 193.
Yeah.
So for all of these Merkle branches, for all these cryptographic proofs that say at every interval what happens to coin 193.
Sure.
And if the Merkle branches say, step 1, Alice deposited it. Step 2, 3, 4, 5, nothing happened. Step 6, Alice gave it to Bob. Step 7, 8, 9, nothing happened. Step 10, Bob gave it to you. Step 11, 12, 13, nothing happened. Then that information convinces you that you have the coin. And then if you want to actually withdraw the coin, then what you do is you can take the Merkle branch, this proof of this transaction, and you can submit it on chain. Then you can wait, and there's some period of time where someone can challenge you with a newer proof that says, oh, now they actually have the coin.
Yeah.
And if no one challenges you, then at some point you get the coin out.
Interesting, and makes a lot of sense. Colin, any follow-ups?
Yeah, so I guess my question kind of follows on this, goes back to the netting aspect and capital efficiency. One of the things that we have in traditional financial markets is the idea of a central clearing counterparty, or just a bank doing derivatives clearing. I wonder, so the system you describe in a payment channel is, I want to send you 5 coins. I don't have a channel with you. I have a channel with Simon, and Simon happens to have 5 coins.
Mm-hmm.
I can send him 5 coins, and he passes it on to you, and that happens near instantaneously.
Mm-hmm.
There may be an issue, though, where I need to pass you 5 coins every day for the next 5 years, and Simon doesn't have that amount of money today to do it.
Mm-hmm.
But we could introduce some kind of fourth entity that would say, right, if Simon doesn't pass you those coins, I will make sure you get those coins.
Mhm.
And that becomes kind of a clearinghouse. And I need to keep some money with it. Simon needs to keep some money with it. Maybe you do as well. Do you see something like that, whether it's centrally or decentralized, emerging or already emerged?
I think things like that can totally, definitely happen. And it's the one thing that's probably worth keeping in mind is that the kind of public blockchain cryptocurrency ecosystem probably can't support kind of actual debt very well. So it can't support the idea that, I'm going to promise to pay you these coins for the next 5 years, and there's some mechanism that'll either insure you or do something to me if I don't pay up, because basically participants are just anonymous and can disappear at any time.
Yes.
And that, I think, is the key reason why so many things in public blockchains, instead of relying on identity-based penalties, rely on these financial penalties
Yes.
in the form of cryptocurrency that gets deposited into smart contracts that can then take those deposits away as a penalty if they prove that you did something wrong.
Yes, interesting. And I guess that kind of leads us to that blurring line between the world of like the enterprise blockchain and DLT and the kind of the public blockchain world. Do you see those two worlds coexisting, or is it kind of an either or?
I'd say definitely coexisting. I'd say there's definitely many places where enterprises can benefit from data going onto the blockchain. One important thing to keep in mind is that pretty much any mechanism on a public blockchain that can work using financial penalties to incentivize people can also work if you assume that there are going to be social penalties to penalize people who misbehave. If you can gatekeep the participants and make sure that those participants actually are vulnerable to whatever your social sanctions are. And that is something that basically you can do, because in order to financially penalize someone, you need to prove that they did something wrong. But then with a blockchain, like if you prove that you did something wrong, you can just publish the proof, and then that published proof is what can be used to apply whatever the social sanction is.
I think we agree that this sequence of events did indeed occur. Then makes it much easier to move on to the so what should we do about it piece.
Exactly. Yeah. I mean, there are plenty of cases where public blockchains can be used as a kind of tool for different kinds of mechanisms to use, in similar to how you would use cryptography, except having different use cases to cryptography. And that's something that you can use even if, for example, you're totally not interested in using cryptocurrencies for financial incentives. So I can just go through one very simple example.
Please do, yeah.
So let's suppose that I'm running an auction, and let's say I have this cup of tea, and because this cup of tea is such a wonderful work of art, it has 11FS on it. There's a bunch of people that are willing to pay thousands of dollars for it, and you have an auction, right? So one of the kind of fairly standard types of auction is what's called a second price auction, where whoever bids the most wins, but they pay as much as the second highest bidder.
Yes.
And this kind of auction is generally considered superior by economists because basically you don't really need very complex strategies to figure out how you should bid. You just basically bid the maximum amount that you would be willing to pay for the item, and if you get it, or you bid that amount, and then if you win, that you'll have to pay less than that amount, and if you lose, that had you won, you would have had to pay more anyway.
That you were willing to.
Yeah. So the problem is, though, that with this kind of auction, you can cheat fairly easily if you're the operator, right?
Yeah.
So suppose, for example, 3 people bid in this auction. One of them bids £100, one bids £200, one bids £500. And I, as the operator, see these 3 bids, and I know that the outcome looks like it'll be the person with 500 who bid £500 wins, and they'll have to pay 200. Now I'm colluding with the person selling the cup in this case, because I am selling the cup, and I insert my own bid for £499. And I can do this because I see what these existing bids are.
Yes.
And so I can insert this bid, and now the same person wins, but instead of having to pay 200, they have to pay 499. Yeah. So the way that you can theoretically solve something like this with a blockchain is you split the auction up into 2 stages, where in stage one, everyone publishes a commitments to their bid. So everyone publishes the hash of their bid on chain. And then during that stage, no one sees the bids. Then Then stage two, everyone reveals the bids. And once people start revealing the bids, well, you can't submit any more commitments because that stage already ended. And so I don't have this ability to kind of cheat you out of those $299.
And that would include the operator as well. Colin, any thoughts on that one?
No, I think it's an interesting method of looking at stuff. And I guess the question that I always have with auctions, and I was reading your radical markets paper review as well. It's interesting when you start to look at how stock exchanges work, and even inside of those, there's lots of different auctions and different types of markets. I'm wondering in this is, given that you have to kind of wait for batches in kind of a continuous auction model, is there not something where you can more or less run a centralized limit order book of some sort to achieve the same effect?
Well, it depends, I guess, on what your use case is. Like in this case, I'm literally talking about an auction where you're selling a cup, and so you want to have like a 2-week period so people can learn about it and figure out what their bid is and so forth.
Yeah.
And there definitely are rationales for running things like order books on some kind of chain.
Yeah.
Like there has fairly recently been this kind of movements toward frequent batch auctions because they give you a lot of benefit in terms of removing the high frequency trading arms race at a fairly low cost, because like you lose kind of a few seconds of information efficiency, but that's not really all that bad. And that's something that could even be, for example, very useful for cryptocurrency exchanges. And I know there are projects that are trying to do that.
Interesting.
Yeah. So, but regardless of what specific mechanism that you're using, unless you want the mechanism to kind of finish on such a short time scale that blockchains are too difficult to use, like in those cases, then the thing that I described probably doesn't work well. But in other situations, that's like totally an improvement to just add these blockchain commitments on, because that just strictly reduces the set of ways in which you can cheat people.
Interesting.
Yeah.
I got to move us on because I think there's so much we could dive into on that piece. But I really wanted to get on to, whilst we're removing centralized actors from auctions, we could also talk about decentralizing Ethereum. There's always this question of, is Ethereum centralized around Vitalik? How do we decentralize Ethereum?
Yeah, well, actually, I think there has been a huge amount of progress in decentralizing Ethereum already. Like, for example, if you just look at all of the concrete governance actions that happened in the last 12 months, number one, like a lot of the features in the Constantinople hard forks that are launching in January basically happened without me. Number two, issuance reduction from 3 Ether to 2 Ether, which is going into Constantinople. I was not involved at all. Number three, the Ethereum quote 1.x stuff, these short-term scalability improvements that are going onto the main chain before we can switch over to sharding. That whole effort started without my involvement at all. The efforts even around like Casper and sharding, like I'm heavily involved in writing the spec, but the actual implementation is being done by something like 5 different teams that are all like basically doing the code and that are all increasingly actively contributing to the development of the spec. So, I mean, I would not have been able to confidently say this 18 months ago, but I really do feel like the community is kind of capable of acting autonomously at this point.
That's really powerful.
I mean, that's definitely not to say that I'm looking at disappearing. That's like that's the thing that the trolls generally tends to interpret me saying when I say things like this, but I'm definitely not disappearing.
Well, so flipping that, what's exciting you and what is keeping you busy?
I have one on that. So you've talked about, I think this is a really interesting point. You talked about a lot of things that have progressed kind of without you having to put your hands into it or get involved or manage it. My question, and a lot of what I hear the trolls that you're referring to talk about is, if something was to go wrong, and essentially we came to something that looked like the Bitcoin hard fork in 2017. Do we expand the blocks or do we do something else? The argument is, a lot of people would look to figures, be it you or be it somebody else from the early Ethereum Foundation. Do you feel confident, or would you feel confident in the future that the Ethereum community could solve something that came to loggerheads like that without you or somebody else from the foundation?
I'm sure that when the time comes to it, it will be able to.
Yeah.
Yeah.
I mean, I guess it's not been battle tested with that, and I guess, and are you okay with it forking? Like, what is, like, I guess it's head and heart situation, right? Because that is a possibility.
I feel like Ethereum is less likely to fork than something like Bitcoin with BCH and BSV and so forth is, because first of all, in the Ethereum community at this point, we've been fairly clear ahead of time what the kind of goals and technical values of the project are.
Yeah.
And so there is this kind of British-style unwritten constitution that's includes things like proof of stake, sharding, the extent to which we value things like immutability, the extent to which we value simplicity versus functionality, and so on and so forth.
It's almost like you never wrote down the principles, but they're there and understood.
Yeah, I mean, many of them are written down, but it's. I mean, this is kind of why I use this British Constitution as an analogy, right? Like, it's the idea that exactly it's all in different places.
Yeah.
Yeah. So.
Interesting. So, what's keeping you excited at the moment? Because you said if it would function without you, but you're not going away. What is keeping you busy, and what's exciting you? Is it the layer 2 stuff? Is it the sharding? Where are you focusing?
I'm definitely spending a lot of time on layer 1 Casper and sharding. I've also been spending quite a bit of time on layer 2 stuff. I continue helping out a lot with Plasma. I came up with a lot of the ideas that went into a Plasma Prime, which is the latest implementation of Plasma. I also continue to be fairly involved in the zero knowledge proof stuff. So I wrote up that kind of example spec of a Stark-based accumulator, and that's basically like similar technology to Plasma Prime, except without the dependence on RSA groups and without the trusted setups.
Well, that makes a lot of sense.
So there's definitely a lot of things on the technical layer that excite me. Another thing that has been exciting me recently is also just the fact that more and more stuff is actually existing. So even something like Maker, for example, right? Like you have the DAI, which is this stable coin, and it launched, retrospectively at the perfect time. It launched right at the peak of the ETH bubble, and it has survived a 91% decrease in the price of its underlying collateral.
Wow.
And the DAI has just been, staying at $1, very, very stable all the way through.
Wow. I hadn't considered that, but it's really interesting to see these public experiments continue to exist and continue to sort of function in the way that they do. Yeah, another experiment I'm looking forward to seeing play through is Augur. So this is the prediction market on Ethereum, and contrary to naysayers, it actually is seeing significant usage. There was over $1 million at one point that was bet on the 2018 U.S. election, and there was this interesting kind of glitch that will lead to a very interesting test of the platform, which is that the actual text of the question in the prediction market said something like, which party will control the House right after the election? And the intent of the question was clear. It's who's going to win the House, and the answer is Democrats. But if you try to answer it literally, it's like, well, the House really only turns over its ownership a bit after the election, so the day after the Republicans still have it, and so the Republicans should win, or it's ambiguous. And one guy actually bet tens of thousands of dollars on basically the idea that the Augur Oracle, which is this decentralized oracle, this other interesting part of the platform, actually that determines what the actual answers to the questions are, will bet like either Republican or ambiguous. Wow.
And so reporting is, I believe, going to happen next month. And so that's when this decentralized Augur Oracle is actually going to make a vote. And we'll be able to see what kind of answers it gives. And it'll be really interesting to watch. It's going to be interesting for sure. Colin, what do you think is up and coming? And do you have any questions for Vitalik on that?
And I guess more generally, there's a lot of things that have come up. Augur has been criticized by a lot of people for potentially bringing out things that we don't want to see. Markets and those types of things, but there's lots of other potential applications where the properties of a blockchain are very, very positive for people who are doing things that otherwise wouldn't have done that on those because of fear of them being overturned or being found out who they are. Is that something you worry about? And have you ever had kind of an Oppenheimer moment about that?
There's definitely are things that I do worry about.
Yeah.
Then, of course, there is the question of like what kinds of things can we practically do to minimize the risk that blockchains will be used for things that we don't want to see them used for. And there are definitely extents to which you just can't do anything, but there are extents to which I think you can do a lot, not even on the technical side, but more on the community side. So as one example of this, if you look at Zcash and Monero gets used on darknet markets a lot, and Zcash barely gets used on them at all. And whereas, like in my technical opinion, Zcash's privacy is considerably superior to that of Monero. And if you ask why, well, the answer basically is that Zuko, the founder of Zcash, does a lot of kind of public signaling where he basically says that this coin is meant for kind of humanitarian things that are good for the world, like protecting people in Venezuela, and not for like trading fentanyl or whatever. And it turns out that like him saying things like that basically leads to the criminal underground not trusting Zcash.
Interesting, because they don't understand the detail of the technology.
Yeah, like they kind of get the clue that this is not the platform, and especially not the community that will be welcoming to them. And to some extent, this can have quite a bit of an impact.
And I know the COO, Jack Gavigan at Zcash, has spent quite a lot of time educating policymakers on precisely how it works and some of the benefits of privacy. And I think that was behind some of Colin's question, which is actually privacy can be really, really good for the individual, and arguably we have too little of it. So how do you imagine yourself in 20, 30 years' time not doing what Tim Berners-Lee has just done and gone, it's not what I wanted it to be? I mean, I guess you can't prevent that now. You're decentralizing yourself a little bit, but do you think community is a big part of that, and can you do more to foster it?
Community is definitely a big part of it in the initial stages. There are limits to the extent to which we can control things, especially very far down the line. Because at some point, if you're successful, your community expands so big that it just has to include all the deplorables just as a matter of numbers. And that's definitely the points at which you have to kind of care about layers other than just the community layer. But in the beginning, it definitely, I think, does make a big difference what applications you talk about, what kinds of things you focus on first, what kinds of things you deliver.
Welcome to Blockchain Insider. I'm Simon Taylor, and joined as always by Colin G. Platt. Colin G. Platt, how are you?
Doing very well, thanks. How are you?
There's also somebody else, if you're watching the video, that you may see in the room with me that's not on a laptop, but is here in person. The one and only Vitalik Buterin. Vitalik, how are you, sir?
I'm good too. What a coincidence.
How about that? What a strange coincidence. So for people who live under a rock and haven't heard of your good self, just remind us briefly the Ethereum project, Vitalik, and your history from Bitcoin Magazine to there.
Sure. So I've been in the crypto space since before it was called the crypto space. Back when I first heard of Bitcoin in 2011, it was really just Bitcoin. And I found out about this thing on the internet. I started getting involved in the Bitcoin community. First as a writer, I co-founded Bitcoin Magazine, and then did a lot of development on the Bitcoin projects initially. And then about 2.5 years after that, I came up with this idea for how to make a blockchain that is more general purpose. And the ideas from that quickly turned into this a new platform called Ethereum, which is what I've been working on ever since.
Excellent stuff. Alrighty. And as a quick reminder as well, we've kind of come a long way in the last year. 2018 has been an interesting year. So what have you seen have been, if you were to look back over the last 12 months, what do you think have been the key insights? We've obviously gone into price correction, and I do recall you putting out tweets when we're at sort of the peak, sort of saying, we've created $1 billion in valuation and billions here and even $500 billion at one point. Have we really delivered anything? Do you think that's a natural force, and where do you think we're at in the markets?
And I think like speculative bubbles and even outside of financial context, kind of hype exceeding reality is something that's just inevitable as a matter of like kind of both human mass psychology and just kind of micro incentives in terms of wanting to talk about the things that people get excited about, because that's how you have good conversations and things like that multiplied by millions of people. So it's difficult to avoid having ups, and then when people realize that their ups haven't been satisfied, it's difficult to avoid the downs. The nice thing about the year, I think, is that the downs are, on the one hand, definitely a time of despair for some people, but at the same time, it's also a good time for the community to have a chance to kind of clean up, for a lot of real work to get done, for technology to kind of keep on quietly progressing, for people who kind of are there for the long term and understand what the space is really about, to see that the technology is continuing to progress. And I think we have seen a lot of progress on the kind of base layer technical front, and I mean, you can talk more at some point about Casper and sharding and plasma and all of those things. There's been progress on applications, and that includes both kind of the more purist sort of fully decentralized kind of consumer applications, also includes some of the enterprise stuff. There's been a lot of progress in just the ecosystem and infrastructure evolving. So I think in general, there's quite a bit of good news beneath the surface.
That's great to hear. So, let's dive into some of that stuff, because Ethereum, as delivered, was, as we know, a proof of work chain, and that got it to where it needs to be. But there is, of course, the big question about the Casper kind of initiative and project, where you always shift it. And I think it was always a stated goal to get it to proof of stake, but there was always the questions and threats about whether or not you could do that at scale, and would that maintain. So talk to me again, for the layperson, what is that shift realistically, and then let's drill into some of the specifics about where we're at.
Sure. So I guess just as an introduction, proof of stake is a different kind of consensus mechanism to proof of work. So proof of work is a way in which the computers that make up the Bitcoin network and the Ethereum network and many other crypto networks kind of talk to each other and agree on what messages to process in what order. And the way proof of work, you can think of it as a kind of sort of voting mechanism where, 1 unit of computing power, 1 vote. That's a huge oversimplification, but it's kind of an okay way to think about it. Proof of stake replaces that with essentially 1 coin inside of the system equals 1 vote. And these two mechanisms are kind of similar because they both use economic resources to gatekeep what level of participation you can have in the network. And that's something which is necessary, because if you don't have that kind of economic gatekeeping, then one participant can just pretend to be a billion fake participants and then take over the entire network. And proof of work does that. Proof of stake does that, in our opinion, better for a couple of reasons. One of them is that with proof of work, in order to prove that you actually have this computing power, you have to basically turn on these computers and have them solve mathematical puzzles 24/7, and this leads to a huge amount of energy consumption. And I think Bitcoin is at the point of exceeding probably the majority of the world's countries, and Ethereum is definitely not nearly at that point, but it's still much higher than I would like it to be. And proof of stake is much more efficient, because instead of proving that you have computers by using them 24/7, to prove that you have coins, you just need to basically sign a digital signature with the same cryptographic key that has those coins. And so the network can run with much lower energy consumption, to the point where the main thing that you're wasting is just the fact that you have these 10,000 nodes that all need to verify every transaction, which is much less.
Interesting. Colin, you had a follow-up.
So, yeah, I had a question on proof of stake. I think it's really interesting. One of the things I'd like to understand is, do we have examples of where proof of stake, either in a blockchain system or outside of a blockchain system, has really worked so far? Or is this all an experiment at this stage?
There have been simpler versions of proof of stake that have worked. So, for example, even back in 2011, there was a cryptocurrency called Purecoin that was released. There was something called NXT in 2013. Tezos is using proof of stake, and they did some kind of initial release fairly recently. There are a couple of others. It actually is fairly popular, but the kinds of versions of proof of stake that have been out so far are fairly simplistic, and the one that we plan on launching with is kind of much more powerful in a lot of ways.
So let's dive into that. What is the one you plan on launching, and how is it different from those simplistic ones that we would have expected to see?
Sure. So the simplistic versions of proof of stake basically replicate the structure of a proof of work blockchain. They just replace the randomness of the mathematical puzzles that people solve with computers with randomness that sort of gets virtually simulated inside of the blockchain. So you still have a structure where you get a block, and then a block on top of a block, then a block on top of a block, some time between blocks.
Yeah.
And that kind of structure is nice because it's very simple and very low overhead, but it's also terrible because it takes a long time for blocks to come to consensus.
The eventual consistency.
Yeah, like basically, like in Bitcoin, for example, there's this idea of waiting for 6 confirmations, and that's like an hour to confirm a transaction. And proof of stake chains that work in a similar way, like basically inherit those weaknesses. Our approach to proof of stake combines together some of the insights from these older chain-based schools of proof of stake with Byzantine fault tolerance theory, which is a branch of mathematics that has existed for about 35 years that focuses on this question of, well, if you have some number of computers, then how do you get them to kind of quickly agree on data, even if some of those computers have been hacked or go offline or something happens to them? And now, that kind of consensus was originally designed in the context of a setting where you know ahead of time that these are the 15 people participating, and so you just give one of them a kind of participation token, and everyone knows who all the participants are.
Yes.
And that's why you can't just directly transplant that into a open public network setting, and that's why Satoshi went over to proof of work initially. But our idea is to take those algorithms and, first of all, kind of merge them together with proof of stake. And second, we came up with an algorithm that has some intermediate properties between the properties of these older BFT algorithms and chain-based proof of stake. So the problem with the older BFT algorithms is that they're designed for like 15 computers. And so if you try to run them with 50,000 computers, you need like extremely powerful computers that, you basically, the only people who would run nodes are like Google. So in our case, we have a version of this algorithm that takes longer to come to kind of final consensus, but still not too long. And even before it comes to final consensus, it kind of interweaves this BFT style of consensus together with a kind of chain-based style of consensus, but also not chain-based. And the benefit that this gives you is that within something like 5 seconds, you get a sort of soft agreement that this block is probably part of the history forever. And then in a couple of minutes, that soft agreement upgrades to a final finality and it's not going back.
Interesting. If any of you are familiar with the world of payments, with Visa, you get auths and settlement, right? When you go to make a payment, the thing that happens when you go to pay with your card is Visa says, yes, there's money in this account. The money doesn't actually move till a day later. That's actually similar, but what you're saying is it's happening on a much more compressed time frame for that network.
Yeah.
Interesting idea. All right, Colin, any further follow-ups on that point? Yeah.
So one of the things that I thought was really interesting in discussion that I've heard over the last couple of months in the Ethereum community is a notion of economic abstraction. So being able to use multiple different kinds of coins or assets to pay fees rather than having to go through only Ether. Can that exist in a proof of stake or in a Casper type setup?
So proof of stake does inherently require there to be one enshrined or privileged currency in the network, because he needs to have one currency that the proof of stake deposits are in.
Right.
And there are reasons why in some cases you might want to enshrine one particular cryptocurrency further. So one example of this is that there are benefits in some cases to having a model of transaction fees where instead of the miner deciding what to accept and you deciding how much to pay, there's some fixed fee that might be adjusted by some mechanism, but it's a fee that the protocol chooses and where the coins actually just get eaten up by the protocol. And if you want to do things like that, you need to have one particular currency that those fees are denominated in. That said, we definitely recognize the usefulness of economic abstraction as a thing that is good for usability and good for making applications more accessible and so forth. But I think there are many ways to achieve this goal. So more recently, we've been kind of bigger and bigger fans of this kind of layer 2 approach to design, where we make the base layer of a blockchain both reasonably simple, but also maximally general, so that if you want to build these more specific features on top, you can build them like basically as software libraries or systems of smart contracts that just sit on top of the blockchain.
Interesting. So that second layer gives you the space to be able to kind of do all of those abstractions in a completely different way, whilst the general layer underneath that is doing the kind of the general stuff.
Exactly.
It makes a lot of sense to me, and it kind of hints at those layer 2 things that we've been talking about historically. Those technologies, plasma and radon are often brought up as potentials in that space, and we also get into sharding. Just walk me through what those technologies are and where they fit within that stack.
Sure. So sharding is a base layer upgrade. So it's an upgrade to the blockchain itself.
Yes.
And what sharding does is it changes the structure of the blockchain so that instead of every single computer in the network needing to download and verify literally all of the data that anyone sends, you break up the data into shards, so basically pieces, and some small random selection of nodes verify each individual piece of data. And the purpose of this is essentially that it allows you to still have the whole chain be verified, but at the same time do not require any individual node to process more than maybe 1/500th of the entire data that's being processed by the chain. And so you increase the scalability of the entire system by a factor of maybe something like 500.
But is there a trade-off there in terms of the overall security, or is that where is that trade-off?
There definitely are trade-offs, but the good news is that there's not any kind of trade-off that says security goes down by a factor of 500.
Right.
Like, there are more naive designs that people have thought of before, where it actually is the case that if each node only needs to process 1/500 of the data, that means that if you break 1/500 of the network, you can break one of the chains. But the more recent designs use multiple layers of defense. Like, one of them is a random sampling mechanism that basically means that if you are an attacker, you don't know ahead of time which nodes will have to verify what data, so you don't know which nodes to take over or attack or become in order to attack a particular part of the chain. There's also something called data availability proofs, fraud proofs, proofs of custody. So these different strategies together that actually do mean that the amount of security that you're losing from this design still exists, in large part just because it is a significant gain in complexity, but it's definitely not a kind of massive decrease in security that'll make the chain vulnerable.
Are you guys testing that, I guess, on a test net, and what have you seen in terms of the gains and some of those trade-offs? Because, I mean, until this is put out to the public, a lot of it is unknown, right? I mean, you guys learn so much every time you do a release. With Frontier, you suddenly see all of the things you didn't think of. Is that a concern going into?
A lot of this stuff is definitely still theoretical, so the test nets are fairly far along in development, but so far the testing has focused much more on the proof of stake side than the scalability side. And our intention is to release the proof of stake part before the sharding part, because we want to have a period which is kind of like an early test where the chain is theoretically running, and you get to test to make sure that the proof of stake parts are all actually working. But also at the same time, it's kind of a real live economic test where the economics of proof of stake are being tested because it's people's actual deposits and money are at stake.
Well, so then you're just testing that. You're not testing that plus sharding. And
exactly. So
risk.
So the point is that we would launch the proof of stake part first, and because with the proof of stake part there's not going to be much activity connected to the chain, it's not even that bad if it breaks, and so we can afford to do more testing earlier, and then when things stabilize a little more, we'll push sharding out, and we'll continue actually implementing and testing the sharding itself in parallel to all of that.
Indeed, that makes complete sense.
Sharding is definitely a challenge in implementation in multiple ways. I think one of the big ones is that you do need to use fairly novel kinds of peer-to-peer networks, because the peer-to-peer networks used in Bitcoin, Ethereum, basically every blockchain and cryptocurrency so far tend to be gossip networks. So they rely on this assumption that every node broadcasts something that everyone downloads, but that's just fundamentally incompatible with the sharding approach to scalability. And so there's a kind of go back to square one moment, though it is something that